Hello guys, and welcome back to the channel. So in today's video, we're going to talk about Tesla earnings and what is priced into the stock and what is not priced into the stock. I got this very interesting idea for a video because I think there's a huge disconnect between the stock price and the reality of the company. And as you know, a huge part of the valuation is not what the company has done, but what are your assumptions for the future. So how much percent the company is going to grow, what is the percent gross margin, what is the percent profit, and you make assumptions from these, and then you get a price. So I want to see what is the price currently reflecting, what kind of growth is it reflecting, what kind of gross margins is it reflecting, so that we can see if it's off or it's dead on, and we should all sell Tesla stock. Spoiler alert, I don't think we need to sell. I think we need to load the boat like crazy. So as always, if you like this content, please make sure you hit the subscribe button. And if you want to go further, get exclusive content and access to me, then check out the Patreon link in the first link in the description box below, where you can support the channel for $5 a month. And by the way, the table that we are going to look at is also available on Patreon. So I'm just going to walk you through this table. I first did this table in May 23rd, 2022, and I updated it a few days ago. And the yellow numbers are the ones that were almost 1 year ago. And these white ones are what they are. So you can see when I first did it, the market cap was almost 700 billion and how much it came down, the PE and how much it came down, the free cash flow, how much it went up, the price to sale, the PEG ratio, and what I projected as growth, and what is the share count. There was a share split, so the shares went up threefold. You can see that I'm calculating with a 40% growth, and this is in line with my last year's projection. And my unit count that they are going to deliver is within a percent correct. So that's a nice feat. I mean, I don't believe that people can, correct things and model things very good. So the question is always how wrong you are, but I will take this 1%. I will take that as a win. So what's cool with this table is that it shows you the amount of vehicles that Tesla is going to deliver if they grow 40% year on year. What is the revenue projections? What is their operating margin projections? What is that in terms of net income? What is the stock dilution? What is the share count? And then I simply take a PE value. Then I times it by the profit, and then I get a future market cap. So as you can see, I'm very interested in 2025. What is the stock going to be worth? And this is what I actually think. Again, you can get this table if you join Patreon, and you get access to this. You click file and then you make a copy, and then you can play around with this yourself and you can put in your assumptions. What's really cool is that you get this is a future stock price, right? So I think that in 2025, the stock is going to be $467. And this is, to me, a quite conservative assumption, because if a company is growing 40% year on year with EPS, and they only get a 40 P, that is a PEG ratio of 1, and that is Peter Lynch very, very cheap and a buy for the stock. So the stock should deserve a higher multiple. And it's also conservative in many ways that I'm going to cover in the future videos, because this is only looking at Tesla as a car company. Zero attention is given to TeslaBot. Zero attention is given to the Robotaxi network. And most importantly, zero attention is given to the full self-driving. So again, another cool feature is that you can put in how much return you want to have, and then this table is going to discount that to what stock price it should be so that you get that return. So if you want a 30% return, then today the stock should be at $186, and then you compound the 30% over 3 years, and then you get 467. Now, you could tell me that 30% is a very high expected return, and you would be right. But the reason why I like to have it is because it gives me a very high margin. That means that I can be very off on my assumptions. And let's say I am, and the company is only growing 30% or 20%, and there is, full of surprises, like Elon retires or turns out that he has 10 other secret kids. I'm still safe with my assumption. And hey, if it becomes only 15% compounded per year, I'm still a happy camper. All right. So what I wanted to see in this video, we can see that according to my calculation, the current stock price is somewhere in the 140s, and we are one day before Tesla reporting earnings. So I want to see how Wall Street gets this number. So I'm going to change my assumptions. So one assumption that we obviously have to see is that we know that Wall Street is thinking that the S&P 500 is doing 9% average return per year. And if you don't want to invest into an index fund, but you want to pick a stock, then it should give a little bit higher than the index fund, right? So let's say that you are expecting a 13% return just to invest into this stock, okay? So this already puts the price at $305. So if this is your investment criteria, then if the stock today would be at $305 with all my assumptions in place, this would be a screaming deal for you, right? So now I'm going to change the numbers a little bit here to see how we can get to 140. And there's a few ways to get to this. So one of them, the growth has to slow down. Number two is, which will result, even if your margins are high, but the growth slows down, you get a lower valuation and a lower profit because you're not selling as many units. So that's one way to change the assumptions. And the other one is that you're still growing very fast, but you're having a very low margin on the vehicles, which again results in a lower net profit, which in turn results in a lower valuation. So I'm going to speed up the video, but let's see how we can get to this $140 current valuation with a 13% expected return per year. Wow. So if I just change the growth rate from 40% to 20%, and then I adjust the PE that we would get without going into changes in the profit margin, you can already see that the stock price goes into the 80s. That was actually a bit shocking to me, how much Tesla's growth is already counted into the stock price. Now, I wanted to speak a little bit about the reality of this. So, and I already see a mistake in this calculation because we are already in 2022. So I need to update this one. Give me one second. All right, so I just discovered a huge mistake, and that was that when I changed the growth to 20%, it started making the growth from 2021. So it took away all the achievements of 2022, right? So now if you can see, if I change the growth back to 20% only from 2023, and I change the PE, and we get a $96 stock price. This is actually very interesting for me, but I want to speak about the reality of this. Okay, so what do we know? We know that Tesla has a few products that haven't come out yet. There is the cheap version, Tesla, that is the $25,000. I don't even know what model they call it. And you have the Cybertruck, which is the world's most anticipated, one of the most anticipated products, with over 1 million pre-orders for this product, right? And we know that they're going to start producing it next year. Then by now, we also know that the price reductions have really worked. And the 20% growth would mean that they go from 1.3 million to almost 1.6 million. And I just don't see how that is currently realistic. But if we look the Wall Street way, this is kind of what is priced in. I mean, okay, let's see what exactly is priced in. Okay, this is close enough for me. So one way of looking at it, this is if the growth disappears, but they still have a high margin. Then what the current price reflects is that the growth rate becomes a perpetual 25%. So that means that no new gigafactories is needed for quite some time. We know that Tesla has a 20 million yearly production target by 2030. This means that the Cybertruck is not selling. Again, no FSD is calculated in this one, no Robotaxi is calculated in this one, and no Tesla bot is calculated in this one. And the way we got to this number is we destroyed the growth of Tesla, but we maintained the margin. And again, this presupposes 25% growth, 25% P, 20% profit margin, 3% dilution on the share. And this is how today's stock price would be a fair deal. Now, let's see if we keep the growth, but we destroy the profits. This is another way of getting to this number. So I'm going to speed this up and let's see what we get. All right, that was a much easier calculation. So here we kept the growth rate at 40%. And by the way, up to 2025, I'm very confident in this growth rate. Sure, I can be off plus minus 10%. But I think it's this calculation that the net profit decreases is a much more likely scenario, because if we still have a recession in 2025 and Tesla has to make continuous price cuts to spur demand, then this might be the case. So if the company is growing 40% year on year and they get a 40% PE, this would and a 9% profit margin would result in 18 billion in a profit. And by the way, that is where they are currently, I believe. We will see when Q4 earnings come out. The rumor is that they might have 5 billion in net profits, and that would imply a yearly run rate of 20 billion. So that means that they wouldn't grow anything for the next 5 years. Then the stock price would be deal for you below $137. Currently, the stock price is $140, but this is close enough for me. So currently, this is how the market is thinking and pricing Tesla stocks. So either the growth disappears, they keep the gross margin, and this is how you get today's stock price, or the growth remains, but they lose the margins. Again, zero attention to FSD, zero attention to Robotaxi network, zero attention given to the Tesla bot. These are all, you get it on buying this. It's a package deal right now. So if you believe that these assumptions from Wall Street are correct, then the stock is correctly priced. And if you think that these assumptions should be lower, then the stock is even currently overpriced. And this is where you can see, let's take Jim Chanos, who is probably thinking Ford has a 3% margin. So Tesla is going to grow up and be a big auto company, and they will have a 3% margin. Ford has a PE of less than 10, but let's give them a 10 PE. And it's impossible. No company has ever grown by 40% per year. Let's say Tesla is growing 20% per year. Then for Jim Chanos, this stock would be a $7 stock, which is insanity. But at least you understand why he went broke shorting the stock, because his calculation and assumptions, this is what he said he would do. So let me know in the comments, what are your assumptions? Do you think that the stock is fairly priced? Do you think it's underpriced compared to based on your assumptions? And let's see the earnings. I'm very excited to see the earnings. I'm going to be making videos on it, of course. And let's keep the hope up, guys. Thank you so much for watching. Make sure you subscribe. Why not check out the Patreon? And I'll see you in the next video. Bye-bye.